You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Market Moose? Mike from The Moose on the Loose. How are you doing on this Monday? This week is a very busy week on the Canadian side because we do have all the banks reporting their earnings. Some of them started last week, and I'm going to do a big wrap up on the YouTube channel. So you can go to Dividend Guy at YouTube. Just Dividend Guy at YouTube, and you're going to find it up. Last week, I actually kind of prep you with a video about which bank is the best one of the Canadian banks. And it's not just like a ranking banking system, but more, I wanted to give you the tools to understand what is each strategy and what they bring, because each bank since 2008 started on a different path and they decided to grow different business units. Some of them went for international markets. Some of them went massively in the US. Some others were about capital markets or wealth management. So different strategies, different outcome. And that video was about all of this. And there was a comment that was quite interesting, and I thought that would bring that perspective on the Moose was, okay, so if you are a retiree, because I mean, the comment was, well, obviously, if you want to buy a bank out of the big six, you're going to pick the one with the best profile. So the best revenue growth, earnings growth, dividend growth, growth perspective, and so on. So long story short, pretty much National Bank, right? I mean, I'm totally biased here, but anyways, you get the point. So you're looking at six companies in the same industry. One of the good way to select the one that you should go for is the one that, of course, you understand the best and that you believe in the business model, but also that is backed with strong fundamentals, right? So good financial metrics, well, chances are you're going to continue to make more money going forward. So his point was, well, that's all great if you want to pick National Bank and you have plenty of years ahead before retiring. But if you're about to retire or if you are retired, well, chances are you're better off with Scotiabank. And the argument was National Bank offer a 3.7% yield where Scotiabank is at 6.5. So kind of crazy, almost double the yield of National Bank. So his point was, well, if you need $50,000 in dividend income to retire, well, it's easier to get it from Scotiabank because you need a smaller amount of money to be invested there versus National Bank. And from what I would call a napkin calculation point of view, so just rounding up numbers, very easy. You have $1 million, you have two choices. You either invest in Scotiabank generating $65,000 a year or National Bank and generating $37,000 a year. Well, sounds like you should go for $65,000, right? That sounds like the best deal ever. So going back to that example, imagine that you need $50,000 per year, and then you just I picked Scotiabank. Well, Scotiabank didn't increase its dividend this year, and it won't. Management said, we are not increasing our dividend this year. So entering next year, you need $51,500, just assuming a small 3% inflation rate. So just to maintain your retirement budget, your buying power, you don't need $50,000 anymore. You need $51,500. So where are you going to get it from Scotiabank? Because you're going to get 50. So there's missing $1,500. So the only two solutions is either you will have to sell shares of Scotiabank, which the reason why you didn't pick National Bank in the first place was to not sell shares. Well, here you go. You're still there. Or you're going to reduce your lifestyle. You're going to cut down on your favorite activities, on your favorite restaurants maybe, or favorite experience. I mean, you just have to cut down, less travel, less gift for the children or grandchildren. But there is something where you need to cut. And in those two options, selling Scotiabank shares while they're down or like reducing your lifestyle doesn't sound like a very appealing options, right? And keep in mind, Scotiabank increased its dividend by 3% last year and 3% the other year before. So it was barely keeping up with inflation already. And now they're just saying, yeah, you know what? We dropped the ball on this one and it's over. The other thing is when you just compare the yield, you ignore a complete aspect of investment because total return is the capital gains plus the yield. And based on all that, I mean, you should not even go for Scotiabank. You should go for Laurentian Bank that pays 7%, right? Well, how in the world could you have retired on Laurentian Bank knowing now that the past 5 years have been terrible for them? They cut their dividend and they show like massive capital losses if you invest in this one. So if you pick Laurentian Bank before 2020, before they cut their dividend over National Bank, well, then you had a bigger problem. And even today, would you feel better picking up Laurentian Bank out of like all the other banks just based on the yield? I don't think it's a good idea. I don't think you can just isolate one financial metric. And in any case, like the opposite would be also the case. You cannot just like buy a stock just based on P ratio alone, or you cannot buy a stock just based on the past 5 years performance because nobody knows what's going to happen. And that is usually the main argument from retirees or income-seeking investors. They're going to tell me, but Mike, the capital gain that you expect to make on National Bank is either A, paper profit, or B, maybe not even guaranteed. And I totally agree with you. The capital gains are not guaranteed at all. The mistake that many of investors do is, well, the dividend is not guaranteed at all either. So capital gain and dividends are two metrics that we both expect to grow or to be sustainable in the future. But the capital gain does not mean that it's going to happen, and the dividend either. I mean, if the business shows a strong dividend triangle where revenues keeps on increasing, so that means that they're making more money and now they're more profitable because earnings per share keeps on increasing, well, two things it will likely happen. The dividend will continue to increase and the stock price will remain strong. But if you look at a business that has shaky fundamentals, that struggles to find revenue growth, that earnings are stable at best, but sometimes declining, well, where do you think that the stock price was going to go? It's going to go down. And where do you think the yield is going to go? Oh, it's going to go up. And it's going to seem like the perfect solution. But in the end, unfortunately, the dividend will not be safe because it is a struggling business. So both metrics, the capital gains and the dividends, are not guaranteed. Now, if we bring this discussion to a broader portfolio, and now we're not just talking about a national bank paying 3.7% and then Scotiabank at 6.5%, but rather having a portfolio generating, I don't know, like 2.5 or 3% yield, which is probably not enough for most of us to retire on, versus a 5 to 6% portfolio. What's going to happen there? Well, of course, you will have to eventually sell shares to maintain your lifestyle if you go for the low yield, higher growth portfolio. And of course, you don't want to sell them during a down market. So in 2022, that was not the right time to sell shares. I totally agree with you. That sucks. So how about you have a cash reserve to bridge those gap years? So whenever there's a bad year, you just get money from the cash reserve, and the cash reserve could be invested in like a GIC ladder or a bond ladder, like anything that is relatively stable, pays a good yield in terms of interest, and that will be easily cashable. So bond, GIC ladder, 3 years, that would be pretty much the idea. So whenever the market is down, you don't have to sell shares. And when the market is up, you sell shares and you create your own dividend with a combination of dividend plus capital gains, which will likely do a lot better than hoping that Scotiabank get back on track and finally match inflation for good, which we don't know what's going to happen. If you want to know more on how to build this type of portfolio and the methodology of having a cash reserve and actually some research showing how high yield are riskier at retirement than low yield, high growth, I wrote the Dividend Income for Life guide, 100% free. You can download it at moosemarkets.com/income. So we start by comparing low yield, high growth to high yield, low growth companies. Then we go into how to build a portfolio that will be more sustainable and shows better fundamentals. And after that, at the end, I explain how to manage the cash reserve so you're not stuck by being forced to sell shares at a bad timing. So again, you can download the guide for free. You just have to put in your email. I'm going to send it to you, moosemarkets.com/income. So to end that debate, yield versus the yield at retirement, the yield doesn't matter. The total return is the most important thing. And I get that it's more comfortable and convenient to receive dividends, but there's no free lunch in finance. If you're getting a high yield, it's because you're taking additional risk. If you don't know what those risks are, well, then you're missing a big point in the story. All right, Moose, I hope that you have enjoyed this one. We're going to talk again tomorrow. And until then, don't forget to stay invested. Hey, welcome to the disclaimer. If you're listening to The Moose on the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.